Investing $500 per month may not sound like much, but over time, it can completely transform your financial future. With consistency, smart planning, and the right strategy, you can build serious long-term wealth, even starting small. Whether your goal is retirement, early financial freedom, or simply growing your savings, $500 a month can go a long way when used wisely. This guide breaks down exactly how I invest $500 each month living in the US, focusing on low-cost, diversified, and beginner-friendly strategies. No confusing jargon, just clear, practical steps that anyone can follow to start investing with confidence. In this video, we will talk about how I invest $500 per month, US-based strategy. So make sure to watch the full video. 1. I start by building a strong financial foundation first. Before investing a single dollar, I make sure I've taken care of financial basics. That means I've paid off high-interest debt, like credit cards, built a small emergency fund, at least $1,000, and budgeted for all essential expenses. This keeps me from pulling money out of investments during emergencies. I also make sure my spending plan includes that $500 each month without hurting my daily lifestyle. Investing should be consistent, not stressful. A solid financial base makes investing easier and safer, so I can stick to the plan for years, even when markets go up and down. 2. I automatically transfer $500 to my investment account monthly. Automation is key. I set up an automatic transfer of $500 from my checking account into my investment account every month, right after payday. This makes investing a habit and removes the temptation to spend the money elsewhere. It's like paying a bill to my future self. I use a brokerage like Fidelity, Vanguard, or Charles Schwab that allows automatic investments into ETFs and index funds. By doing this monthly, I practice dollar cost averaging, which means I buy investments at different prices over time, reducing risk and making investing feel smooth and stress-free. 3. $300 goes into a broad market index fund, S&P 500 ETF. The largest portion of my $500, about $300, goes into a broad market index fund like Vanguard's VOO or Schwab's SCHB. These funds invest in hundreds of top U.S. companies at once, giving me instant diversification and low fees. I'm not trying to pick winners. I'm investing in the entire market. These index funds have returned an average of 7 to 10% per year over decades. I reinvest all dividends, and I don't touch this money. It's for the long haul, my future self age 50 or 60. It's a simple, powerful way to grow wealth over time. 4. $100 goes into a total international stock ETF. To make sure I'm not putting all my eggs in one country's basket, I invest $100 monthly into an international ETF like VXUS, Vanguard Total International Stock ETF. This gives me exposure to companies in Europe, Asia, and emerging markets like India and Brazil. Global diversification helps me reduce risk in case the US market underperforms. While international stocks can be more volatile, they also offer long-term growth potential and help balance my portfolio. Having a global perspective with my investments adds strength, especially when economies around the world recover at different speeds. 5. $50 goes into a US bond ETF for stability. To balance out my stock-heavy portfolio, I invest $50 monthly into a US bond ETF like BND, Vanguard Total Bond Market ETF. Bonds offer steady income and reduce volatility when the stock market dips. While bond returns are lower than stocks, they act as a cushion during rough times. I'm young enough to focus mostly on stocks, but this small bond portion gives my portfolio stability. It also helps me stay calm and stick to my strategy during market crashes, knowing not all of my investments are moving in the same direction at once. 6. I use a Roth IRA for my long-term investing. Because I'm investing for retirement, I prioritize using a Roth IRA. It lets me invest after-tax dollars and grow my money tax-free, which means I pay no taxes when I withdraw in retirement. That's huge. In 2025, the annual limit is $7,000, or about $583/month. Since I invest $500/month, I stay well within the limit. If I hit the income limit for Roth IRAs in the future, I'll consider switching to a traditional IRA or using a taxable brokerage. For now, my Roth IRA is my go-to account for tax-free, long-term investing. 7. I invest through a low-cost brokerage with no account fees. Fees eat into your profits, so I use a brokerage that charges $0 for trades and has no account maintenance fees. Great options in the U.S. include Vanguard, Fidelity, Schwab, and M1 Finance. They offer access to all the ETFs I need and allow fractional shares, so I can invest exact dollar amounts, even if the ETF price is $400 or more. These platforms also support automatic investing, dividend reinvestment, and portfolio tracking, all things that help me stay consistent. Choosing the right platform makes investing easier, cheaper, and less stressful over time. 8. I reinvest all dividends to boost growth over time. Whenever my investments pay dividends, small cash payments from stocks or ETFs, I set them to automatically reinvest. Instead of taking the cash out, I use it to buy more shares. This leads to compound growth, where my investments earn money on previous earnings. Over time, this snowballs into much bigger returns. I don't have to think about it or do anything manually. It all happens in the background. Reinvesting dividends is one of the simplest but most powerful habits for building wealth. It's free, automatic, and helps me grow faster without extra effort. 9. I review and adjust my plan once a year. I don't check my investments daily. I don't need that stress. Instead, I review my portfolio once a year to make sure it still matches my goals. If one part has grown too large, like the stock portion, I rebalance by adjusting future contributions or moving small amounts to other funds. I also check for any tax or IRA rule changes and make sure I'm still on track for retirement. Staying consistent is more important than being perfect. A yearly check-in helps me keep my plan solid and adjust for life changes without overreacting to short-term market noise. 10. I stay consistent and don't try to time the market. The most important part of my strategy isn't which ETF I choose. It's staying consistent every month. I don't try to guess when the market will go up or down. I invest the same amount each month, no matter what. This takes emotion out of the equation and helps me build a habit. Over time, the market has always gone up, even after crashes. My $500 monthly investments may not seem like much now, but in 20 to 30 years, thanks to compounding, they could grow into hundreds of thousands of dollars. Consistency is the true secret to building wealth. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.